Okay, now we're up to the last and final principle of investing, and that's to win by not losing. And what we're looking at here is to make sure that you don't have the big downturns. Warren Buffett has two rules for investing. The first rule is never lose money, and the second rule is look at rule number one. So that's what we're going to focus on some little things you can do to ensure that you win by not losing. So one of the easiest tools to use to help protect your portfolio in a down market, and something that I do for clients, is looking at the 200-day moving average. Now this 200-day moving average is a very simple tool. You take whatever holding you have. In this case, we're looking at the S&P 500, which is representative of the U.S. stock market. You go back over the past 200 trading days and you average the closing price. So when you factor in weekends and holidays and items like that, 200 days is essentially about a year. So you're looking at a year's worth trend. Any time that the market is trading above the 200-day moving average, you want to be invested. If the market breaks below the 200-day moving average, you want to sell that holding and go to cash or short-term bonds. And what you can see here is a back testing all the way to 1900 through 2008. Now the S&P 500 was only created in the 1950s, but this was kind of back tested to say, what if we'd had it since 1900? But if you look at this, you can see that the annualized return over that 108-year period for the S&P 500, if you just held it, is 9.21%. Using the 200-day moving average, your return would have been 10.45%. Now, ultimately, that's really not a huge difference in return, but where you do see a big difference is in the volatility. And the volatility is measured by the standard deviation. So for the S&P 500, you're looking at almost 18% standard deviation, whereas the 200-day moving average, you're looking at 12. So you're looking at a third less risk, or volatility, I should say, with the 200-day moving average as opposed to just buying and holding the S&P 500. You can also look at the Sharpe ratio. This is named after William Sharpe. He won the Nobel Prize for looking at his work on the markets. And then you can kind of see what the best one-year return was for each the S&P 500 and for the 200-day moving average, as well as the worst 1 year. So for the worst year, you're looking at almost 44% for the S&P 500, and then for the 200-day moving average, we're looking at just shy of 29%. So to put this in a different perspective, what this chart shows you is the worst 10 years for the S&P 500 dating back to 1900, and what would the return have been with the 200-day moving average, where you sold when the market broke below the 200-day moving average. As you can see, some pretty big down years for the S&P 500, ranging from 43.86% down to just 14.69% down. For 200-day moving average, much better returns here. I think if you had a choice between either the S&P 500 column or the 200-day moving average column, you're certainly going to take that. 200-day moving average only had 6 down years of the 10 worst years for the S&P 500. So 4 of the worst years for the S&P 500, you would have actually had a positive return had you been following the 200-day moving average. So you can see this provides you with a much more consistent return. And that's the whole key for using the 200-day moving average. It's the consistency. It's creating a tighter bell curve for your returns. So if more and more of your returns fall within that minus 10 to up 30%, and you avoid some of the really big downturns, minus 40, minus 50, and you're also going to miss some of the big upturns of 40 to 50% returns, but you're creating a tighter bell curve. It's what I say, you're eliminating the fat tails. Your returns are going to show up a lot more consistently, and this is going to help you, it's going to help you sleep a little bit better at night. That's probably the biggest thing it's going to do. But again, as you can see from the previous slides, it's going to give you a consistent return with just less volatility. And isn't that really what people want? They want that equity-like return, but they don't want to have as many ups and downs with the stock market. And the wonderful thing about the 200-day moving average, it not only works for U.S. stocks, but it also works for international stocks. Here we have the EFA, which is the benchmark for international stocks. It stands for Europe, Australasia, and the Far East. And compare that to the 200-day moving average. And here again you can see the return for the EFA is just over 9%, whereas the 200-day moving average, we're looking at a little bit over 11%. But again, the big key here is the volatility. We're looking at a third less volatility with a little bit better return, and that's the key. Further, you can see what the worst year was for the EFA, down almost 50%, whereas with the 200-day moving average on the EFA, we're just north of 23%. So those are much better dynamics for an investor than just the buy and hold. The 200-day moving average also works for commodities, which if you watch my other presentation, commodities is the most volatile asset class of the 4 equity asset classes. Here we have the Goldman Sachs Commodity Index, and you can see that we actually have a statistically substantial increase in return by using the 200-day moving average, and not as much of a difference on the volatility level. So, rather than getting a third less volatility, we're really only looking at about 1/5, maybe 20% increase, a better volatility with the 200-day moving average. And you can also see the worst year. You can see commodities are very volatile. We're looking at over 60% down year for commodities as its worst one year, and then still down about 38% for the 200-day moving average. So we still have a pretty substantial benefit by using 200-day moving average with commodities. Along with U.S. and international stocks, as well as commodities, the 200-day moving average also helps you with real estate investment trusts. In fact, I think this is probably the one asset class where it really pays the biggest dividends, if you will, using the 200-day moving average. Here we can see a statistically significant increase in performance between buying and holding the REIT and using the 200-day moving average. And we're also getting a sizable difference in volatility, even more so than we see with stocks and definitely more than we see with commodities. So again, if you look at the worst one year with REITs, you've got almost 58% negative year, but if you use the 200-day moving average, you're looking at a worst one year of only 21%. So again, with all these asset classes, you can really see that you can minimize your downside by utilizing the 200-day moving average. And it doesn't really impact your return. In fact, with some asset classes, it statistically improves your return. And isn't that what we want as investors? We want a better return with less risk. It's kind of the panacea for investing.